If you are new to the channel, join Retirement Lifestyle TV, where we discuss finance, health, wealth, investment, crypto, and much more. Please subscribe to our community. Greetings, everyone. Welcome to yet another edition of Retirement Lifestyle TV. Today, we're going to dive into a necessary, but not necessarily pleasant topic of the impact of high inflation on your retirement planning. Let's start by understanding what high inflation is and why it is a concern for your retirement planning. One of the most significant impacts of high inflation is the erosion of purchasing power. As prices rises, the value of your retirement saving diminishes. High inflation means that the money you save may not cover future expenses effectively. High inflation also brings about price instability. For instance, on the West Coast, gas prices could be as high as $7 per gallon. And let's just say here on the East Coast, maybe Virginia or North Carolina, gas prices could be half that. Tops $4 per gallon. That's what we're talking about. High inflation amplifies price instability. Let me give you yet another example. Consider you had your favorite meal and it cost $10 today. If high inflation persists, the same meal might cost $15 or more a few years from now. Your purchasing power has eroded, meaning that the same budget that you used to provide a satisfying dining experience now falls short, forcing you to allocate more of your income to cover basic expenses like food or gas. Inflation does have an impact on young savers. Inflation can significantly impact young savers in their 20s or 30s. As a retirement advisor, I am well aware of the importance of starting to save early. Inflation erodes purchasing power and money over time. So for young savers, it means that the money that you put away today won't have the same value when you retire and in the future. For instance, if inflation averages 2 to 3% annually, the cost of living could double or triple over several decades. This means that even if a young saver is financially disciplined and put money into a saving or investment account, the real value of these savings may just decrease. To combat this, it is crucial to invest in assets that can outpace inflation, like stocks and real estate. There's not that many assets that can outpace inflation and perform high enough rate where you can have a real rate of return. One of those assets over a long period of time based on historical data is the S&P 500. Regularly reassessing your financial plan and readjusting for inflation is essential to ensure that your financial goals that you set in your 20s and 30s remain achievable in retirement and in the future. For retirees, many rely on fixed income sources of income like pension, annuities, or bond. High inflation can create challenges here. As prices increase, fixed income do not keep pace with the cost of living. This can lead to a reduction in the standard of living, forcing retirees to dip way into their savings. Additionally, fixed income securities like bond may experience a declining rate of return. This means that a retiree investing in bonds may have to hold on to it longer than they originally intended, affecting their attractiveness to investors. To combat these effects, investors often seek inflation protection securities or diversify into assets with growth potential to maintain their wealth and income in the time of inflation. The best protector, or should I say fighter, against high inflation is permanent income. Here are some examples: Social Security, a pension, and also purchasing an annuity. High inflation also has implication on investment portfolios. Certain investment may underperform in a high inflation environment, impacting your overall wealth. Retirees need to adjust their investment strategies to protect against inflation and seek assets that can provide real rate of return. This leads me to share two examples. The first one is related to the inverse relationship I have seen with some of the historical data related to inflation and stock performance. The inverse relationship is when inflation is running high, we see that the stock performance runs low. And vice versa. When inflation is low, we see that we're in the positive areas for rate of return for like the S&P 500. The second example is when you're taking distribution from your nest egg when you retire, or if you're retired, a negative performing stock year is the worst time to take a systematic withdrawal distribution. Let's just say, for instance, in 2022, we had double-digit negative stock performing year in the S&P 500. And we also seen that inflation was high. That's that inverse relationship that I'm talking about. Those are the years where you do not want to take that systematic withdrawal from your nest egg to provide you with income. You want to make sure you get income elsewhere or cut back severely on spending during this high inflationary time period. Such bad timing or simply just not being aware can actually cause your entire nest egg to underperform for the remaining years. Let's wrap up by discussing strategies for a more inflation-resistant retirement planning effort. Inflation erodes the real rate of return for fixed income investments. Invest in short-term securities like TIPS and CDs. So let me tell you about TIPS. TIPS are Treasury Inflation Protected Securities. And they're short-term, 3 months, 6 months to a year. And the returns are really high at this point. It's upwards of 5% return on your cash. Adjust your budgeting strategy. Review and adjust your budget to accommodate rising prices. Prioritize essential expenses and minimize discretionary spending. Emergency fund. Maintain an adequate emergency fund to cover unexpected costs without depleting your investment. We talked about liquidity ratio of a 3.0. That means you have enough savings to cover up to 3 months of expenses. So that's key as well. Seek professional advice. Consult with a financial advisor to create a tailored plan that safeguards your finances in a high inflationary period, like we are in today. Stay tuned for more episodes. If you receive any value from the information that I shared with you today, please consider subscribing to the channel, Retirement Lifestyle TV.